Good afternoon, everyone. While everyone was watching Bitcoin struggle to hold 100K, something way bigger just happened in crypto. Four developments in December 2025 that the mainstream media completely missed, but Wall Street didn't. And when you connect the dots, you'll see why. 2026 isn't about speculation anymore, it's about infrastructure. Let me show you what I mean. Let's start with what looks like total insanity on the surface. August 2025, Ripple and the SEC finally settled. 4 years of legal warfare is completely over. Ripple pays 120 million, way less than what the SEC wanted, and suddenly XRP is a legitimate regulated asset. You think moon time, right? But here's what actually happened. XRP closed 2025 down 13%. Meanwhile, Bitcoin down 18%, Ethereum down 27%. So XRP actually outperformed all the majors, but still negative returns after a legal victory. Here's the thing mainstream media isn't connecting. Institutions do not care about price pumps. They care about regulatory clarity and supply mechanics. And that's where things get very interesting. Exchanges holding of XRP just hit an 8-year low. That's not panic selling, that's strategic accumulation. Institutions are quietly moving XRP off exchanges into custody. ETFs alone absorbed over 1 billion. That's supply shock territory heading into 2026. The price drop isn't weakness, it's the calm before the institutional infrastructure kicks into high gear. Retail sees red candles, institutions see discounted accumulation before the supply crunch. Everyone freaks out when Ripple unlocks 1 billion XRP from escrow each month. Oh no, there's some sell pressure. But let's look at what actually happens. Ripple returns about 70% of that escrow. In December 2025, only 300 to 400 million XRP actually hit the market. Meanwhile, ETFs are absorbing billions of dollars of XRP. Institutions are locking it up for years. This isn't day trading, this is strategic positioning. And here's what Wall Street analysts like Bitwise are saying quietly. We're looking at a spring loaded setup. Retail traders see boring sideways action and they leave. Institutions see compression before expansion. The regulatory clarity hits Senate markup in January of 2026. That's more regulatory certainty that's coming our way. More institutional products being launched, less XRP available to buy. You do the math. XRP's 2025 performance looks weak on price charts, but it reveals institutional accumulation patterns that precede major moves. The market is being reset from retail driven to institutional driven. November 2025, Ondo Global Markets gets approval from Liechtenstein financial regulator to offer tokenized stocks and ETFs across 30 European countries. That's the entire European economic area, over 500 million potential investors. But here's what makes that revolutionary. These aren't crypto wrapped derivatives, these are real securities, custodied properly, fully compliant, tradable, 24/7 on blockchain rails. If you're in Tokyo, you can trade Apple stock at 3 a.m. If you're in London, well, Amazon shares are liquid on Sunday. And the SEC just closed their investigation into Ondo. The translation of that is regulatory approval in both the United States and the EU. That is unprecedented. Ondo is also launching on Solana in early 2026, which means tokenized securities will have the speed and cost efficiency of one of the fastest blockchains. The tokenized asset market hit $1.47 trillion in 2025. BlackRock, Fidelity, Franklin Templeton, they're all moving in. But Ondo, they're the bridge that makes this accessible to retail globally. And that is the real story. Okay. The Basel Committee, basically the global banking standards body, created crypto asset rules that were supposed to go live globally in 2026. Now, most countries, they're stalling. The US, still trying to figure it out. Europe, micro regulations, they're a bit different. But Hong Kong, they're going full send on January 1st. And here's the twist: they modified the Basel rules in a crypto friendly direction. The original Basel standard says permissionless blockchains were too risky. Stablecoins on Ethereum would get a extremely high risk weighting. That means banks would need to hold $1 in capital for every $1 of stablecoins, basically making it unworkable. Hong Kong's version is more flexible. Their guidance allows for lower risk weighting on certain stablecoins and tokenized assets on permissionless blockchains if proper risk management is in place. The translation of that is Hong Kong banks can actually engage with DeFi, stablecoins, tokenization in ways that US and European banks currently can't. And this is Hong Kong saying we're a crypto banking hub of Asia and maybe the world. Hong Kong is creating a competitive regulatory arbitrage. While Western banks wait for clarity, Hong Kong banks are building the crypto traditional finance bridge today. First mover advantage of institutional crypto infrastructure. Every other CBD pilot in the world, digital dollar concept, digital euro experiments, they're all designed to be like digital cash. You hold it, it sits there, no interest, just like physical currency. China just said, we're going to do something different. Starting January 1st, if you hold digital yuan in your wallet, you earn interest, just like a bank deposit. This is huge for a couple different reasons. It directly competes with commercial bank deposits. Why keep money in a traditional bank when the government-backed digital currency pays interest? That's a massive shift in monetary dynamics. Second, it makes adoption way easier right now. Nobody wants to see a ECNY because it's just digital cash. There's no benefits, but interest bearing, and that's incentive. China's state media is calling this a shift from digital cash to digital deposits. And third, China is setting up for a global digital yuan operations center in Shanghai. They're not just thinking domestic, they're thinking international. An interest bearing blockchain based currency that settles instantly, that's competition for SWIFT, for dollar dominance, for entire cross border payment systems. Here's the key insight here. This isn't just a technical upgrade, it's a strategic weapon. An interest-bearing CBDC fundamentally changes monetary policy tools. It creates direct competition with commercial banking. Other central banks are watching nervously. Okay, so here's where things get really interesting. We've got 4 separate stories. There's one story with many different chapters here. XRP gets regulatory clarity in the United States. Ondo gets regulatory approval in both United States and the EU for tokenized securities. Hong Kong implements banking standards that let traditional banks touch crypto properly. China creates a CBDC that actually competes with traditional finance. What's the common thread? Infrastructure. These aren't speculative crypto plays. These are rails that are being built, the pipes that connect traditional finance to blockchain technology. And here's what mainstream analysts might be missing. In 2025, this was the year most crypto prices disappointing. Bitcoin failed to hit 150K. Ethereum underperformed. Altcoins got crushed. Everybody talking and predicting bull market basically has gotten it wrong. But while prices were flat down, infrastructure was being built at a record pace. Grayscale's 2026 report calls it the dawn of the institutional era. A16Z calls it crypto going mainstream. These aren't crypto bros that are just hyping. These are institutional researchers with billion-dollar positions. The pattern is clear: regulatory clarity, institutional access, infrastructure build-out, capital flows. That is 2026. Let me address the elephant in the room. Bitcoin ended 2025 at around 86K, down from its October high of around 126K. Every major analyst prediction was wrong. Michael Saylor said 200K. Arthur Hayes said moon. Bitcoin maxis said institutional FOMO. Critics use this to say, see, crypto is dead. Institutional adoption didn't happen. But that's looking at it from the wrong metric. Price is a lagging indicator. Infrastructure is the leading indicator. But here's what did happen in 2025. The stablecoin market grew to over 200 billion. Tokenized treasury products hit 2 billion. Institutional custody matured. Regulated exchange got proper licensing. Banks started actually offering crypto services under real regulatory framework. The October flash crash revealed something very important. Crypto is now correlated with Wall Street. That's not a bug, it's actually a feature. It means institutions are in, and when crypto crashes because macro deleveraging hits, that's legitimacy, not failure. Okay, let's zoom out for a second. The World Economic Forum estimates tokenization could hit 10% of global GDP by 2027. That's very aggressive. Boston Consulting Group says 16 trillion in assets could be tokenized. These aren't crypto publications. These are McKinsey level research firms. But until 2025, it was all theoretical. Oh, tokenization will be huge someday. Well, someday is here. Ondo's EU approval, Hong Kong's Basel implementation, XRP's regulatory clarity, these are dominoes that are falling that make tokenization practical. The real estate tokenization is now possible with proper legal frameworks. Private equity tokenization is already happening. Carbon credits on the blockchain, live. US Treasury bonds already tokenized, and trading is 24/7. This isn't replacing traditional finance, it's upgrading it. Same assets, same regulations, but now with blockchain efficiency, instant settlement, fractional ownership, global liquidity, 24/7 markets. Tokenization is moving from a proof of concept to production infrastructure. The regulatory clarity achieved in 2025 removes the last major barrier. 16 trillion opportunity is now actionable. Here's the uncomfortable truth about China's bearing digital yuan. It competes directly with commercial banks. Think about it. Why would you keep money in commercial bank deposit earning 2% interest when you could hold a government-backed digital currency earning similar interest with zero default risk? The IMF could potentially be terrified of this. Their November 2025 report spends entire sections on CBDC design implications for financial stability. The translation is, if everyone moves money from banks to CBDCs, banks can't lend, and that is a problem. But China does not care about protecting commercial banks the same way the US and Europe does. They want central control, and interest-bearing yuan consolidates monetary control. It gives the People Bank of China direct access to every wallet, every transaction, and fully visible. And internationally, this is currency competition. If China can offer instant settlement, low fees, and interest on digital yuan to trading partners, that's pressure on dollar dominance. The US is actually banned from creating a retail CBDC thanks to President Trump's 2025 executive order. Europe is moving slowly. China is full speed ahead. The CBDC race isn't about technology, it's about monetary sovereignty and geopolitical power. China's interest-bearing yuan is a strategic weapon in the currency wars, not just a payment innovation. So, putting it all together, what does 2026 actually look like? First, banks start offering crypto products for real, for real. Hong Kong Basel implementation goes live January 1st. That's the template. Other jurisdictions will follow. Suddenly, your regular bank can custody Bitcoin, it can offer tokenized asset products, settle transactions on blockchain rails. Second, tokenized securities go mainstream. Ondo's approval opens the floodgate, others will follow. By the end of 2026, you'll be able to trade fractional shares of real estate, private equity, traditional stocks 24/7 on the blockchain. That's trillions of new liquidity. Third, the supply dynamics on assets like XRP start to bite. All that institutional accumulation, it takes supply off the table. New demand for regulatory products, more buyers. February 2026, more US legislation is going to hit. That's more clarity, more products, less supply. Fourth, CBDC competition is going to heat up. China's digital yuan starts getting used internationally. Europe speeds up the digital euro development. The US debates whether banning CBDCs was actually smart. This becomes a geopolitical issue, not just a tech issue. And here's the contrarian take on this. Bitcoin might underperform other crypto assets in 2026. Here's why. Because the real action is in utility. XRP for cross-border payments, Solana for tokenized securities, Infrastructure tokens, maybe like Canton, that power actual financial services. Bitcoin is like digital gold, great for storing value, but the growth is in the rails, not the reserve asset. Okay, in closing, so here's the bottom line. While everyone was watching Bitcoin's price and panicking about the 2025 bear market, the real revolution was happening in the background. XRP got regulatory clarity, Ondo cracked tokenization, Hong Kong built crypto banking standards, China created a competitive CBDC. These aren't random events, they're infrastructure. 2026 is when the infrastructure starts processing real volume. When banks actually offer these products, when tokenized security hits scale, when supply crunch meets institutional demand, look, this isn't financial advice. I'm not telling you to buy anything, but what I am telling you, if you're still thinking about crypto like it's 2017, you're missing what's happening. The game has changed. The players have even changed. The infrastructure is being built out right now. I hope that you all enjoyed this session. Have a good evening.